Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week on a fairly pivotal, call it news event, which was over the weekend, the rating cut of US Treasuries by Moody's. Um, Now, this shouldn't necessarily come as a surprise to anyone, given the fact that, out of the three rating agencies, Moody's was the last one to maintain the AAA rating for US debt. The other two have already um, moved at least one notch lower. And, we had talked about the fact that the treasury market or the safety of the treasuries has started to become more and more put into question, especially after April 2nd, when we saw a pretty significant sell-off of treasuries alongside with the sell-off in equities. Typically, bonds and equities have an inverse relationship. So when we have a risk-off environment where investors sell equities, they usually take that cash and buy safer assets like bonds. But we saw during the April 2nd sell-off that that did not happen. We saw positive correlation. That was the first sign that not all things were well, that there was a combination of selling across the board. So, this news event is not in itself necessarily enough to move the markets, but it is something that I think isn't something that investors need to be increasingly aware of and concerned about as the treasury market, grows to over $36 trillion in debt, and what that means for the US budget in terms of being able to service that debt and our ability to service that debt. This is something that I think for a lot of investors, it's a tough thing to wrap your head around, what $36 trillion worth of debt really means and how that affects markets going forward. But this is something that we need to start learning more about and better understanding with regards to investing in the long term. What's interesting is the equity markets, the way that the equity markets responded yesterday, with the market opening up about 1% lower on the news, but by the end of the day, we were effectively flat and actually positive on all of the market indices. It really just speaks to the optimism that investors currently have with the current market conditions. We have seen a very substantial rally here in equities from the 4850 lows on the S&P now up to call it the 6,000 level on the S&P. This is by all means overextended at this point. There are certainly signs of exhaustion here on this move higher here. You have effectively only one level of resistance here around 6,100, 6,150 here to the upside. The question is, are we going to get up there? Or are we going to potentially start failing and potentially start trading lower from here? There's certainly more and more risk of a pullback here as equities continue to move higher. There are, like I said, plenty of signs of exhaustion here. And we're seeing it across on most of the other indices as well. You see it on the NASDAQ 100, basically higher highs in price. Notice the histogram on MACD no longer making a higher high. So we're seeing signs of exhaustion here on most of the major indices. You see it on IWM, which actually has not even managed to get back above, this 210 level, which is an important double top that has been put in place. And then if you look at RSP, equal weight S&P 500 index, hasn't even gotten back above, these highs that we recently put in at 182. With the same level of sort of exhaustion that we started to see here, higher highs in price, no longer being confirmed by higher highs in terms of momentum. So as we approach these major important levels here on the S&P and the major equity indices, there are certainly increasing signs of exhaustion here from buyers that lead me to believe that there is a higher probability of a pullback here in the short run here over the next few trading sessions and beyond that. So it's incredibly hard to time that per se as to when that pullback will materialize. But that's really where, I'm looking for a pullback here below, the recent swing highs from, I'm sorry, the recent swing lows here from the last few trading sessions as an opportunity that if we break below those levels, that is an opportunity to potentially, start adding some short exposure here to the broader markets. Growth has continued to outperform value here over the last couple of months after that sell-off here. Gold and oil have both moderated quite a bit here from their highs. That commodities overall has moderated. One interesting thing to see with yesterday's price action is that HYG, high yield corporate bond ETF, did not really budge on yesterday's news, meaning concerns around credit from a corporate perspective is not there, still providing more of a risk-on environment and kind of explains the price action we saw yesterday from equities despite the news over the weekend with Moody's removing the AAA rating here for Treasury debt. And then, we see VIX yesterday pick up, but settle back down around that 18% level here. In the short run, I think we're going to get stuck here around this 18 level. But, if we do get a pullback here, that's really where I think at the moment investors are underpricing the risk of a bigger pullback here over the next month or so. VIX trading at 18%, I think, is VIX trading below 18% is definitely a risk here for investors and potentially an opportunity for option buyers who are concerned about a bigger pullback here to potentially look at buying some put options going out about a month to hedge some downside risk or downside exposure that we see here with the broader markets. The 10-year yield yesterday did manage to settle back below 4.5%, which is an interesting dynamic given the sell-off that we saw here in bonds. We have the 30-year yield back above 5%, the 10-year yields, still around that 4.5%. And this is one that we'll continue to watch because, as you can see, TLT is basically retesting its 52-week lows. Treasuries haven't broken down below those 52-week lows, but if we do, that's going to send the 10-year yields back above 4.6%. And I think when you see yields back above 4.6%, if you do, that's going to change the calculus for a lot of equity investors because right now equities are yielding about, call it 4.4% a yield. And if you think about the calculus with regards to, do you risk, an equity type? Do you take on the risk of equities, for roughly what is equal to the same yield as you earn if you're buying treasuries? That is not going to be an equation that works out very well if treasuries are yielding, 4.6, 4.7%, and equities are yielding below that. So, overall, I think we're in an environment that's tough for equities to continue to rally from where we are right now, especially as we start facing, some major resistance levels here on most of the major indices. Again, my gut feeling at the moment is that over the next few trading sessions, we can start seeing potentially some risk of a pullback here in the equity markets. Looking at the dollar index has pulled back here, below that 50-day moving average. But it has continued to make a series of higher highs and higher lows, and we're looking for that potentially to continue to break out above that 101.50 level here, which corresponds with that 50-day moving average. And our upside target is all the way in the 106 area. So there's not a lot of resistance here in the dollar index until you get to around the 106 area. So a big potential opportunity for dollar to rally from here, especially if we keep yields, if we keep interest rates high and yields continue to climb. We continue to see other central banks around the world look at cutting rates. So that is in the short run beneficial here for the US dollar. And then looking at gold, like I said, we're off that all-time high around 3,500. We've made a couple of series of lower highs and lower lows. We haven't broke below the 50-day moving average here, but that's the test coming up next. And the relative strength here of gold has really collapsed a bit here over the last 3 weeks or so. And there is a risk of a bigger pullback here in gold if we do break below that 50-day moving average. And oil, same thing. We've kind of bounced off of those 52-week lows multiple times to test that 63, $64 area, which now corresponds with that 50-day moving average. And there is a risk of we see some further pullback here in oil as well, alongside with gold. And then when we look at sector rotation, this is really where the rotation has been happening in few of the interesting sectors. We saw quite a few sectors in the leading quadrant in terms of momentum and relative strength. Those sectors that have been in the leading quadrant are all losing ground here at the moment. And what's recovered are the lagging categories or the sectors that have been lagging for the last few months. Namely technology. Basically, since the beginning of 2025, technology has underperformed the S&P 500 by a pretty wide margin, but it has gained back nearly all of that loss just in the last 6 weeks or so since the April 2nd sell-off. So technology has had a pretty significant bounce back to where it was before. And the question is whether that can continue or that is a bigger risk for the pullback here. I think there's an argument that could be made that if you are concerned about a bigger pullback, that technology shares are, a particular sector that you might want to get some bearish exposure to. Consumer discretionary has underperformed the S&P 500 since December, but has gained some of that back here over the last few weeks. Not quite enough, in my opinion, but gains from certain back. Communications remains resilient. Financials remains fairly resilient. But if you look at sectors like consumer staples, that has been really outperforming the S&P 500 since the beginning of the year, has checked back and given back most of that outperformance here in just the last few weeks. We see it across consumer discretionary. Consumer staples. We see it in healthcare, which has been a pretty good performer here over the last couple of months to playing a little bit of defense, but again, giving away all of those gains and more in just the last few weeks. Materials starting to turn a little bit lower here. Industrials, on the other hand, has actually continued to outperform the S&P 500 since the beginning of the year. It's actually made a new 52-week high over the last few trading sessions. So industrials, the only sectors making new 52-week highs, across the board. Even technology has not managed that. Real estate continues to suffer a little bit, especially as interest rates remain fairly stubbornly high. We've seen inventory levels continue to rise steadily in the US, but that has not translated into any additional increases in housing starts or home sales. And that's really kind of what we're seeing across the board. Are these higher interest rates have taken a hit on home sales, home improvement. We saw Home Depot miss on earnings this morning. So there's definitely a combination of home builders and real estate that have continued to underperform in this particular market. Energy has given up all of the gains as well for the year, after the decline in oil prices here have really stank energy stocks as well. Utilities sort of still holding on in there in terms of, utilities also making a new 52-week high here yesterday. So this is one that, we should be paying attention to here right now. And then as you can see, home builders continuing to underperform, and semis playing a little bit of catch up here, but, is this a little too late? That is still my hunch here at the moment, that the outperformance that we've seen in semiconductors over the last 4 or 5 weeks, I think it's going to be tough for that rally to continue to hold and continue to move higher here. So that is one sector that I'm more concerned about and at risk of further pullback if we do get a correction here in the equity markets. So looking at opportunities in the markets, there's a few that I think are worth paying attention to here right now. First of all, looking at industrials and the strength there, United Rental, I think is worth taking a look at here. As you can see, it recently kind of broke down from its trading range, but recently kind of completed this bottoming formation that kind of broke out here above that 660 resistance level here. That breakout here on both on absolute and relative basis is relatively strong. Our upside target is around 750 or so. So we're still about 25 bucks away from that upside target. And United Rental trades at a discount relative to its peers, around 16 times forward earnings versus about 18, 19 for its peers. Yet it's expected to grow effectively in line with the industry, but it's far more profitable than the industry. So the fact that it trades at a discount reflects, some of the short-term upside opportunities that we see here for United Rental. Another stock that I think worth paying attention to here right now is Paycom. As you can see, Paycom recently broke out from a new 52-week high above that 240, 245 level here, broke out on both an absolute and relative basis. It does trade, effectively in line with the industry valuations, around 29 times forward earnings, and it's expected to grow at the same pace of the industry, but it is far more profitable than the industry. Its net margins are approaching 21% versus the industry is around 10%. So it's far more efficient at generating net profits than its peers. So for those reasons, I think that the fact that it trades in line with the industry reflects a valuation that still has room to expand to the upside. Intuit. Intuit recently exhibiting a fair amount of strength here over the last couple of months here, kind of on a both relative and absolute basis. Intuit trades again similar to Paycom, in line with the industry, but it grows faster than the industry. It does trade at 30 times forward earnings, but it's expected to grow top and bottom line, 14 to 12 to 14%, which is exceeding the industry. But more importantly, it is also more profitable than the industry as well. So, net margins around 18% versus 10% for the industry. So the fact that it grows faster and has higher net margins, yet from a valuation perspective, it is basically in line with the industry, reflects some further upside opportunities for Intuit. In the semi space, I do like Micron. As you can see, Micron recently, took a bit of a hit here, but recently recovered nicely above that $90 level and is now broken out above that $90 level and has continued to rise from a relative performance perspective. And, it trades at 9 times forward earnings, which is a heavy discount relative to its peers, which is currently around 24 times forward earnings. Yet it's expected to grow top and bottom line far faster than the industry, and it's more profitable than the industry. So the fact that it trades at such a heavy discount relative to the industry is part of why I'm taking a bullish view here on Micron, even though I have some concerns around the sector overall, with the strength of semis. But the valuation looks compelling enough to take a look at that. Zoom communications, we are doing this session over Zoom. We do it every single week over Zoom. And their recent AI companion has been doing quite well here in terms of sales, and presents a nice opportunity for Zoom. It trades at only 15 times forward earnings versus the industry average is around 28 times forward earnings. So it's trading at nearly half the valuation of its peers. And there's a part of the reason that it's trading at such a low valuation is because the growth rates for Zoom are on the low end, but because net margins are approaching 22% versus the industry is around 10%, that's part of why I feel that there's quite a bit of upside opportunity here for Zoom. And I do think that growth expectation can start to pick up, but as long as net margins remain strong, there's an opportunity, in my opinion, for further upside here for Zoom. And then flipping over to the bearish side, the first thing I want to take a look at here is Apple. I've been pretty vocal about being bearish on Apple for quite some time. We've taken short positions here in Apple on almost every single significant rally over the last few months. So the fact that we're kind of rallying again, I think is an opportunity to add some short exposure. It's trading at 29 times forward earnings, even though it's expected to grow slower than the industry. The only thing going for Apple is, are its net margins. Net margins have been pretty consistent around 44%, versus the industry's around 9%. So it's far more profitable than the industry, and that's what's, for the most part supported its relatively rich valuation. But, as the outlook for Apple continues to look fairly, what's the right word? There lacks a lot of optimism about the future of Apple, from their recent fumble with AI and the launch of AI. Their pretty significant investment, over $100 billion investment in AR with Vision Pro, and the fact that they're having, companies like Meta and Snapchat are eating its lunch in that particular space. I think there's a lot to be desired for Apple, and right now I don't see a very strong pipeline for Apple that would justify trading at 30 times forward earnings. And that's why on this recent rally here into that 210, 215 level, I think it's another opportunity to add some short exposure here for Apple, like we have been doing all year. Looking at Abelmar, this is a stock that has continued to underperform here. This is let's look at a weekly chart here real quick. This was a $300 stock that's now trading at $60. It's trading at 343 times forward earnings, right? So just absolute ridiculous valuations that it's trading at. It's expected to grow basically flat. We're not expecting much growth from this particular stock. Net margins are negative 22%. So just everything is falling apart with regards to Abelmar, and any small rallies present an opportunity to potentially sell into that. So that's really where we see this recent rally into that $62 level as an opportunity to add some further short exposure and seek further downside into that $50 downside target for Abelmar. Another one is Zillow Group. We talked about the fact that the real estate market has continued to struggle, and Zillow, as you can see, has lacked the the bounce alongside with the rest of the market here. It sold off, but hasn't really bounced and continues to make a series of higher highs and higher lows. And that's why I think there's some further downside here. And the valuation here for Zillow is also quite concerning. It's trading at 42 times forward earnings versus the industry's around 18 or 19. It is expected to grow a little bit faster than the industry, but with net margins that are negative 3%, that's really where the valuation falls apart. Even if it is expected to grow a little bit faster than the industry, the fact that it's not profitable is a big concern in this market condition, and is at risk of some further pullbacks here, in my opinion. And then lastly, I'll leave you with one last name, which is T-Mobile. This is a name that has, over the last few years, performed quite well. But as you can see from the chart, there are some signs of higher highs and higher lows that we continue to trade in. And as we rally into the top of that channel, I think there's an opportunity to potentially add some bearish exposure. T-Mobile trades at 22 times forward earnings, which is effectively double what the industry average is, right? Think about AT&T and Verizon. They trade at relatively low multiples. T-Mobile trading at 22 times is quite high. And historically, they grow faster than the industry and they're slightly more profitable than the industry. But I think we're entering an environment where that trajectory in terms of growth is starting to slow down. And with net margins that are not particularly higher than the industry, there's some concerns around the valuation that it's trading at, at nearly double what AT&T and Verizon are trading at. So for those reasons, I think looking at T-Mobile, there's an opportunity to add some bearish exposure here going forward. So with that, that covers what I wanted to share with you here today. Hopefully this gives you a good understanding of kind of where we currently sit with the broader equity markets and some ideas here for the week. Thank you so much and have a great trading day.